Hi, this is Mrs. Simonson, and we're getting ready to start Chapter 4, where we're continuing to look at transactions. And in this case, we're going to look at them and add something called debit and credit parts. And so the big idea for this chapter is in accounting, you need to analyze transactions and put them into debit and credit parts. And we're going to learn more about what that means in section 4.1. So looking at 4.1, we start off and talk about something called the chart of accounts. So we learned in chapter 3 that an account is a place where we see the increases and decreases in a specific account like cash or like capital. And some businesses, small sole proprietorships only need 20 or 30 accounts. A large company is going to have thousands to several thousands of accounts. And so we're taking and we're recording these changes in accounts. The book talks a little bit about a manual system, which doesn't really exist anymore, but it used to be a book. So cash would be on one page and then capital be on another page, or a card system. Basically, all this stuff is computerized now. We keep all these accounts in something called a ledger. So the ledger is referred to as keeping the books when you're maintaining the ledger. It's a place to go where you need to find the balance of any account. You can find it at any time during the month in the ledger. Then we need to take these accounts and put them into sort of a system and refer to them with a number. Small companies just have a few numbers, few digits, and then obviously large companies, the account number could be something like, 35 digits. In our book, in this example, throughout the chapters, they have the chart of accounts. The assets begin with 1, liabilities with 2, and they're hundreds or whatever. Owner's equity is 3, revenue 4, and expenses 5. And those are the 5 different types of accounts. So here is our book example, zip delivery service. This is their chart of accounts. It looks like they have 15 to 20 accounts here. All the assets are beginning with a 1, and it kind of moves from the most liquid asset to, more long-term, although they don't have a building or land or anything there. They have 2 accounts payable, and notice now how we're writing these. We're writing these accounts payable and then the company name. Owner's equity is going to have a couple more that we're not really ready to use yet, but the person's name, comma, capital. The owner also has an account called their name and withdrawals. And then the income summary account, unfortunately, we're not going to learn about that till chapter 10. So that's a little mystery account. It has to do with the net income at the end of the month. 400s, they just have 1 source of revenue, and they only have 4 expenses here. So huge topic here, double entry accounting. And how to record transactions in a more usable way. We've been going, let's see, here's our problem that we were working with. And this way of recording transactions isn't feasible, because what company only has 6 accounts? So while this is easier for you to understand that assets are on the left and here the right side of the equation, it doesn't make sense, because you'd be scrolling to the right because you have hundreds of accounts. So to change that, we're going to use something called double entry accounting. We're going to analyze transactions and put them into debit and credit parts. And so there's a little bit of confusion with those 2 words, because you think about a debit card and a credit card, but I want you to erase that from your mind, and simply debit is the left side and credit is the right side. And it's always that way. And when I was in high school, the way, if you need to memorize it, I think it becomes really clear. But like I said, okay, credit has an R in it, that's the right, and then debit's on the left. When we go to analyze transactions now, this chapter, we're going to use something called a T account. It's not really used in formal accounting, but whenever I have a problem and I can't figure out, when I'm like, I got to figure out this transaction, and going through it in my mind, the first thing I do is I draw a T. So T accounts are a tool to analyze transactions. It's not the way that we formally do accounting, but it's a good tool to use. The left side of the T account is always the debit. The right side of the T account is always the credit. There's nothing ever different about that. Left is always debit, right is always credit. Some people use the definitions DR for debit and CR for credit. I don't use that, but that is just something from the book. A little bit about the rules of debits and credits. Debits and credits are used to record increases and decreases. We'll no longer ever have a negative number in accounting. It's going to be a debit or a credit. In double entry accounting, for every credit, you have an equal debit. So just like the sides of the equation are balanced, every debit has to be the same as a credit in order to keep our equation in balance. Debit and credit rules differ depending on if you're an asset, a liability, or an owner's equity capital account. Another term that we're going to talk about is something called a normal balance. The normal balance is wherever the increase side is on an account. And we're going to do those rules here in a second. So just important to know whatever side is the increase side is also the normal or kind of usual balance side. Kind of cool thing that this book does, I like this, is that it always shades the normal balance side. So let's talk about rules real quick, and then we'll look at a problem. Rules for asset accounts. An asset account is increased on the debit side, and it's decreased on the credit side. The normal balance side is the same as the increase, so the normal balance side of an asset account is a debit. While what I take from that is that here's my equation: assets equal liabilities plus owner's equity. Assets are on the left side of the equation, so the left side is their increase side, and that's how I remember it. So a little bit more here in the book. They kind of have a plus sign and a negative sign, meaning increase or decrease, but again, we never have negative numbers. We always want the increase side to be more than the decrease side so that it does have a correct balance. Like, it would not work out to have a cash credit balance because that would mean that we're negative. So if we look at just an example, so here's cash in bank. So the T account is a T. It has the name of the account on the top. And, right in the beginning, we might write debit up here and credit up here, but we wouldn't have to because debit's always on the left, credit's always on the left. So they've had two transactions where they increased cash and two transactions where they've decreased cash. So if we add up the increases and we subtract the decreases, cash currently has a debit balance of $240. And you would say the word debit in that sentence. The rules for liability and capital, I would say, are exact opposite of assets. Liabilities and owner's equity increase on the right side. Okay. They decrease on the left side. Their normal balance side is the right side. And for me, that just makes sense because where are they on the equation? Asset equals liabilities plus owner's equity. They're on the right side of the equation. So the right side is their increased side. And the book goes on to say that the debit and credit rules for each of the two on each side of the equation are mirror images. So the asset rules are mirror images to the liabilities and capital account. They give us a quick little example here of accounts payable and the capital account, and they had two decreases to accounts payable and two increases. So we're going to take the increases and subtract the decreases, and currently accounts payable has a credit balance of $200. Similarly, in capital, they had two increases, two transactions that had increases, two transactions that had decreases. We take the increases, we subtract the decreases, and currently capital has a credit balance of $34.50. Really good kind of clarification here is that debits and credits, when you think about your debit card and your credit card, they're not the same as a debit and a credit because cash is increased on the debit side, but when you use your debit card, you're decreasing cash. So just keep that in mind, throw that out of your head. It's not the same at all.